Budget 2026 to 27 sets the tone for India's next phase of growth. With public capital expenditure proposed at 12.2 lakh crore rupees, a fiscal deficit targeted at 4.3%, and a brand new income tax act kicking in from April 1st, 2026, this budget is less about short-term relief and more about structural direction. For businesses, says units, IFSC entities, and investors, this is a year where policy signals matter as much as numbers. The budget openly acknowledges a challenging global environment. Trade disruptions, supply chain stress, geopolitical fragmentation, and rising competition for critical resources like energy, water, and minerals form the backdrop of this year's proposals. Against this, the government's message is clear. India will stay globally integrated while strengthening domestic manufacturing and strategic capabilities. The emphasis is on resilience, export-oriented growth supported by long-term investment and predictable policy frameworks. Public capital expenditure continues to be the anchor of economic strategy. Capex has risen steadily from about 2 lakh crore rupees a decade ago to over 11 lakh crore in the current year, and now to 12.2 lakh crore for 2026 to 27. At the same time, fiscal consolidation remains intact, with debt to GDP projected at 55.6%. For industry, this combination signals sustained infrastructure creation without abandoning fiscal discipline. Semiconductors and electronics components receive another strong push. ISM 2.0 seeks to deepen the entire value chain, from materials and equipment to Indian intellectual property. Alongside this, the electronics components outlay is proposed to rise to 40,000 crore rupees, reinforcing India's position in global electronics manufacturing. Rare earth corridors proposed across Odisha, Kerala, Andhra Pradesh, and Tamil Nadu aim to reduce import dependence by integrating mining, processing, and manufacturing. Complementing this is the challenge route model for chemical parks, designed as plug-and-play industrial clusters. The budget also addresses manufacturing depth. High-tech tool rooms, a construction and infrastructure equipment scheme, a container manufacturing program with 10,000 crore rupees over 5 years, and an integrated textile push, including skilling through Samarth 2.0, are all meant to strengthen industrial SMEs and logistics ecosystems. Infrastructure continues to move beyond roads and rail alone. New dedicated freight corridors, including the Dankuni to Surat link, aim to ease logistics bottlenecks. 20 new national waterways are proposed over 5 years, starting with National Waterway 5 in Odisha, alongside a coastal cargo promotion scheme. To address financing risks, the Infrastructure Risk Guarantee Fund is proposed to provide partial credit guarantees during construction. At the same time, asset recycling through CPSE-led REITs is expected to unlock capital and deepen infrastructure markets. Carbon capture, utilization, and storage receives a 20,000 crore rupee allocation over 5 years. The objective is to prepare heavy industries, power, steel, cement, refineries, and chemicals for large-scale decarbonization. While this signals seriousness on climate commitments, actual adoption will depend on future clarity around commercial models, incentives, and carbon standards. The budget introduces city economic regions as a new framework for urban-led growth. Each region may receive up to 5,000 crore rupees over 5 years through challenge mode, results-linked financing. Alongside this, 7 high-speed rail corridors are proposed to connect major city pairs. Together, these initiatives aim to turn Tier 2 and Tier 3 cities into investment and employment hubs. But success will hinge on governance and execution quality. One of the most consequential announcements is the confirmation that the Income Tax Act 2025 will come into effect from April 1st, 2026. The stated objective is simplification, cleaner law, redesigned forms, and fewer disputes. Several easing measures accompany this transition. TCS rates are reduced for overseas tour packages and for education and medical remittances under the liberalized remittance scheme. Taxpayers can revise returns up to 31st March with a nominal fee, and return filing timelines are staggered to reduce last-minute pressure. Penalty and prosecution provisions are proposed to be rationalized, with integrated proceedings and lower pre-deposit requirements in appeals. For the IT and IT-enabled services sector, the budget proposes a unified safe harbor framework with a common margin of 15.5% and higher eligibility thresholds, moving approvals to a rule-based system. For IFSC units, the budget proposes extending the tax deduction window to 20 consecutive years out of a block of 25 years, followed by a concessional 15% tax rate after the holiday period. There is also a proposal to rationalize deemed dividend provisions for treasury centers subject to conditions. These changes materially improve long-term tax predictability and warrant immediate remodeling of business plans. For says manufacturing units, a one-time measure is proposed to allow DTS sales at concessional duty rates limited to a prescribed proportion of exports. While the intent is clear, supporting SEZ facing global disruption. The operational details will depend on follow-up notifications, including eligibility criteria, export linkage, and duty computation methodology. On indirect taxes and customs, the direction is towards speed and trust-based compliance. Duty deferral for Tier 2 and Tier 3 AEOs is proposed to be extended to 30 days. Advance rulings may remain valid for 5 years. Courier export value caps are proposed to be removed, and baggage rules are set for rationalization. A shift toward warehouse operator-centric self-declarations with risk-based audits signals deeper segmentation between compliant and high-risk trade participants. In summary, Budget 2026-27 reinforces continuity in public investment while sharpening focus on strategic manufacturing, logistics efficiency, and tax administration reform. The biggest winners are infrastructure-linked sectors, advanced manufacturing, compliant exporters, and globally oriented financial services. The key watch-outs lie in execution. Many benefits depend on subsequent rules, challenge mode selections, and system readiness before April 2026. The immediate next steps for businesses are clear. Track the finance bill and notifications closely. Update compliance calendars for the new tax regime, re-evaluate IFSC and SEZ eligibility early, and prepare documentation well ahead of operational rollouts. In this budget, preparation, not reaction, will determine who gains the most. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence. A pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup. Operational support and handling complaints, risk management renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BATF, and ancillary regulations and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.